Hey, welcome back to the channel. My name is Mac Rogers. I'm a real estate broker here in the San Francisco Bay Area. I wanted to revisit this question of a pending crash because of all the changes that's happening around us. All the chatter about recession, inflation, mortgage rates increasing, sales seems to be slowing down, mortgage applications also significantly down, which has a direct correlation to the number of potential home buyers out there. Even Redfin came out with a study showing that there's an increase in price drops. This is why there's been so much speculation about a housing bubble or a crash. I think actually there might be a different scenario. We could also be headed into a correction. With the Fed's increasing interest rate, it's really creating all these additional pressure in the cost of buying a home. All the frenzy that surrounds the spring and summer home buying season seems to be fizzling, and we could be seeing a shift. Sam Cater, Freddie Mac's chief economist, said in a statement, "It continues to be a seller's market, but buyers who remain interested in purchasing a home may find that competition has moderately softened." If this slowdown continues or really materializes, what could follow is a crash or a correction. No one wants a crash which could result in huge price drops and eventually lead to foreclosures again. A correction on the other hand would mean prices coming back down to earth and home price appreciation going back to levels that are more sustainable. With the current state of the housing market, I think a correction is more likely. 3 reasons. There is an imbalance in demand and supply, more demand than supply. This imbalance has led to tremendous equity for homeowners. And finally, the strict lending standards that we have right now. A repeat of 2008 is highly unlikely. So we're going to look at a couple of topics to get a sense of how this whole real estate market will play out. And at the end of the video, I will give you my take on the broader market and also here in the San Francisco Bay Area. Let me start with this graph. This is the home price appreciation since World War II. Now, I know you're probably wondering, what the heck, why am I sharing this, right? Well, after World War II was the start of this modern housing market that we have, the American dream. GIs coming back and wanting to have their own piece of the American dream. And if you look at this graph, you can see that there's only one time in history or since World War II that home prices took a massive hit. Yes, there were dips here and there if you look yearly, but when you look at it over the decades, it was only in the mid-2000s that home prices plunged. There's 3 main reasons for this crash. One was loose lending standards. Loans like Ninja loans. Ninja stands for no income, no job loans. You didn't have to verify your job or assets. When you hear that today, it sounds ridiculous, right? But that was a big thing back then. I know hindsight is 2020, but we all know how that turned out, right? You got basically people just saying whatever income they have in order to qualify for a loan. On top of this, most of the people applying for a loan didn't have great credit scores. The barrier to get a mortgage loan was not just low, it was subterranean low. Like I said, there were a lot of borrowers that to begin with weren't credit worthy at all, or the risk were high getting approved for loans that they really couldn't afford. A second big thing that was happening, many people were treating their homes like an unlimited ATM, cashing out left and right or equity harvesting. Now don't get me wrong, there's nothing wrong with cashing out your equity if you need it. But most people were funding their lavish lifestyles, jet skis, luxury cars, vacations. Some were buying several other properties as investments that, again, with their credit and income profile, had no business buying more properties. They probably shouldn't even have bought the first one to begin with. And before I forget this, another key distinction, a lot of those purchases were either very low down payment or 100% financing. In some cases, a buyer doesn't even have to come out with money out of pocket. Everything was funded by the loan. Again, the thinking was it was never going to end. It was just going to continue to appreciate forever. And what happened when the houses started losing value? Well, people just walked away from their homes, especially the ones that did not have money in the properties. Why save it if you didn't spend a dime? Plus, in a lot of cases, they were actually making money off of the properties as rental income. And the third is supply. We had a lot of properties back then. I've said it before in this channel. Back then, if you told me you wanted to buy 3 or 4 properties this month or in the next 2 months, that wasn't a problem. I can guarantee you that I can find you those 3 or 4 houses. Today, if you tell me that, I might just tell you, let's pool all that money and buy one house because it is that competitive. We are severely short of housing inventory right now. So those are the three that contributed to the housing market crash that you see on the chart. We had like over 9 million homes that were in distress, either in foreclosure, short sale, or deed in lieu of foreclosure. So fast forward today, what are we seeing in the market? I'm going to show you what we have today as opposed to what was going on the last time. Take a look at this latest forecast. This is from the 7 experts that I follow. None of them are calling for home prices to go down. In fact, they are calling for more appreciation. The average is around 9% right now. At the beginning of the year, the average of all these forecasts was only at 5%. I said it at that time that I see them revising the forecast upwards, and that they did 4 percentage points higher than their original forecast. That's a big upward bias. And this is already considering the current mortgage rate climate that we have. The 5% average at the beginning of the year didn't take into account mortgage rates to be this high. Okay, I just want to give you a quick disclaimer. I'm not saying that this alone doesn't mean that we won't have a crash or home prices won't lose value. All I'm saying is that there are no experts out there saying we will have a market crash. Again, quite the opposite. With us coming out of the pandemic, a lot of people are asking, what about those homeowners that got affected by COVID? You know, those homeowners that were on forbearance and for one reason or another may have been permanently affected by it. Well, let's look at the latest forbearance numbers. The numbers are just continues to edge downward. Under 700,000 right now. This was around 4 million when we started the pandemic. And what happens when these people come out of forbearance? 37% of mortgages were paid in full. 44.6% are in a workout plan. 18.4% are still in trouble. So clearly, from this data, if there was a crash, it won't be because of forbearance. Also, those 18% that's still in trouble, if you're thinking about that, those homeowners, or at least a majority of them, will have enough equity to sell their homes if they really needed to because of all the equity growth that we've had in the past 2 to 3 years. I don't see anyone walking away from their homes when there's money there. Let's look at lending standards now. One thing is clear when we had the housing crash. Clearly, lending standards at that time deviated from normal or logical lending standards of the past. Banks were trying to package A-paper loans with subprime loans, thinking that it will cover up all the stink the bad loans would produce. And we all know that didn't work out according to plan. Take a look at this next graph that I have. It shows you lending risk, comparing the 2000s to today. Product risk and borrower risk. What you see there in the red is product risk. Product risk is basically your ninja loans or your liar loans, the ones that I talked about earlier. That has been virtually eliminated. You can't go into a bank or a lender and find these types of loans right now. And the other is borrower risk. In other words, the credit worthiness of borrowers. How strong is a borrower? We are talking about credit scores, credit history, your income, your asset, your debt to income ratio here. The borrower's capability of paying a loan. Again, the risk is much lower than before. And the result of all these tighter lending standards, even before we had the foreclosure moratorium during the pandemic, foreclosures have been significantly reduced already. Before the pandemic hit, we were less than 500,000 in foreclosures as compared to the height of the foreclosure crisis at almost 3 million homes in foreclosure in 1 year. Also, like I said, credit worthiness is a big thing right now. Take a look at the number of loans given to borrowers before that had credit scores under 620. That is less than half of what it was before. Banks are not lending money like they were before to people that have credit scores of less than 620. Another part of this new lending standards, which actually was in the news lately, is the percentage of ARM loans or adjustable rate loans. I have a video about that here. It is at a record low, but because interest rates are going up, it's starting to pick up again. Look at the comparison between then and now. We are not even close to those numbers. Most of the borrowers of today have been opting for 30-year fixed rate mortgages and not adjustable loans. And by the way, adjustable rate mortgages are not bad. It was just misused. People or borrowers that shouldn't have been able to borrow were put on adjustable rate mortgages just to be able to qualify without really regard as to how they can repay it in the future. And as mortgage rates continue to climb higher, I believe this percentage will continue to go up more as borrowers will want to lower their monthly payments. I'm not concerned about this since lending standards are tighter now. Let's look at inflation. This is another big thing right now that people are asking me. What I hear is something typically like this. As inflation rises, people aren't going to be able to afford their homes. I want you to take a look at this study from the Feds. It's the household debt service ratio by household. The study shows that today, the ratio is way below what it was when compared to the mortgage crisis. 3.8% versus 7.2%. This is the percentage of debt as compared to personal income. The lower the number, the better. And we are, according to this study, most Americans are in good shape. Last thing I want to share with you before I give my final thoughts on this is cash out refinances. Look at this graph. This is the difference in monthly payments and cash out refinances, comparing them from the last time. Basically, what this number is, you take your original monthly payment, and then when you cash out, you take that new payment and get the difference. Take a look at that huge difference. The bottom line for this, when you're looking at this, that it's not a burden to people cashing out, not like before. The housing bubble that caused the 2008 crisis can be summed up like this. It was a combination of cheap and easy to get mortgage, which fueled speculative demand from most buyers that weren't even qualified, plus there was also a lot of housing inventory. Now, where do I see the housing market going? I think on the broader market, when we look at the overall numbers, we will start to see weakness. And the reason I say this is because you're going to have regions around the country that benefited from a lot of people moving in there because of the cheap housing. Those markets might start to slow down or even go down because they're not going to see all these influx of new people coming in. And also the fact that houses are really getting to be so expensive. The other thing is, as the workforce starts to normalize again, I actually believe that workers will be forced to come back, and maybe a small portion of people that went away will be forced to come back closer to their work. Here in the Bay Area, that has already started. Apple, Google, and other companies are calling back their employees. The overall arching theme of this market is still shortage of inventory. If that continues to persist, which it seems like it will, we will continue to see more upward pressure on prices that could also act as a support to soften any blow on home prices should demand go down. So far right now, even though there are less buyers out there, it's still not enough to tilt it into a buyer's market. However, I also believe that there will be a point where buyers will simply just say, we're not willing to pay for these prices anymore. If that happens, we can see a lot more price reductions and prices finally leveling off. When will that be? It's hard to predict. And one final note that I want to add, consumer confidence is key. Look, we can have all these great numbers that we have right now, or even if the Fed stops raising rates and mortgage rates goes back down, if consumer confidence is lacking, we can still see a correction. Hey, that's our video for today. Thanks for watching. Have a great day. Please hit the like and subscribe button.